Hey guys and girls, welcome back to another update for the commodities. Now most of the charts have declined since our last update. We'll do a bit deeper dive into that, plus we'll do some back testing. Before you go any further, make sure you hit that like and subscribe button to support the channel. But first off, in terms of today's analysis, the August 3rd outlook, high-grade copper, the outlook is bullish, driven by resilient global demand from the green energy transition and electric vehicle sectors. Supply remains a concern due to mine delays and declining ore grades, while regional imbalances and new tariffs are creating price anomalies that are expected to support prices. Iron ore, the market is transitioning to a surplus, while Chinese demand is expected to decline. Significant new supply is coming online from projects like Guinea's Simandou and production increases from Australia and Brazil. Prices are expected to find support around $80 to $100 level, but the long-term trend appears to be one of softening. Spot gold and silver, the outlook for both is bullish, driven by geopolitical instability, economic uncertainty, and the flight to safety sentiment. Central bank demand for gold remains strong, while silver is seeing a boost from both its safe haven status and strong industrial demand from the solar and electronics sectors. Platinum, the platinum market is experiencing a persistent and growing supply deficit, which is creating structural pressure and driving prices higher. A strong rebound in industrial and jewelry demand, coupled with constrained mining production, has led to a significant price rally. US crude oil, the outlook for US crude oil is mixed, while geopolitical tensions and supply cuts by OPEC provide some price support. Increasing US shale production and a potential slowdown in global economic growth could put downward pressure on prices. Overall, the market is subject to significant volatility. Also, do keep a lookout for all the plus one videos, and that's where we look at various strategies to test our means of generating income through trading these commodities. So first, looking at high-grade copper, looking at the monthly first. So the monthly chart is showing a pretty strong decline with the CCI already broken below the moving average band. We did have a divergence back here with these lower highs on the CCI, very long-term divergence, bearish divergence, versus this period on the price chart. Now notice there, I'm going to increase that, this one actually, I'm going to increase that trend line to that point there. It hit that resistance, and that is going to be an extension of the CCI still declining, so that's still a bearish divergence. Now in terms of a retrace on the bearish divergence on the monthly, we're going to measure it from that high down to that significant low before that divergence started, and what we're looking at is, you can see there it's already broken in a 23-38% range. So that's already happened, and it looks like it may possibly fall further. Now what we also did as well, we identified this fair value gap down here. So that could be an area where the price does retrace back to, very long term. This could take months or even years to play out, so don't go placing short orders with that target there. This is simply like almost like a support area, let's call it that. But that's a fair value gap with orders unfilled. All these other fair value gaps have been filled since, and at the moment just bouncing off that moving average range at the moment. But predominantly I'd call it a neutral positioning, the price above the moving averages and the CCI is below, so I'd say neutral positioning, not quite long or short. On the weekly, however, very strong pull down on the price chart in alignment with the CCI breaking below, so both breaking below the moving averages, giving us a bearish outlook. You can see there we had a fair value gap identified and one down here as well. It will break right through that, both of those areas, and it looks like it's still pulling back. There's no divergence there on this one. The CCI is moving in line with the price, so there's no divergence there. And zooming out, there's no other fair value gaps that I can see that haven't been filled on the weekly. On the daily, this one actually has a lot more. You can see there, it's since our last video, it actually broke up into that initial fair value gap, covered that range, and then it finally dumped pretty strongly to the downside, filling this fair value gap, which I identified previously, this one back here. That's why it was marked with this red rectangle, but also with this bearish divergence, double top on the CCI versus higher highs in the price, it broke down into that blue rectangle was our divergence target. So what we got now on the micro chart, this is the 1 hour, so we only go, in this case, we're going short in direction of the daily. So you would have been going short. Now here, you'll notice back here, we had a bearish divergence on the 1 hour versus high highs in the price. We had a target range there. And as soon as it hit that range there with that candle, you probably could have started taking short orders because both the price and the CCI below the moving averages. And at that point there, that was coming in line with this price breaking below that moving average range on the daily. So you would have started going short. Now first, going back on the daily, showing you back here with the two strategies going long from that period. You can see there the stop loss approach is pretty much breaking even. In fact, you're down about $700 odd on the stop loss approach, and on the average down approach, if you're going up to that point, you made quite a few returns. But again, remember our strategy of the high level strategy. We always close it out when the daily breaks into the moving average range. So for that point there, for example, here on the hourly, you would have gone long, and you would have closed it out when the daily at the very latest broke down into that moving average range. So you would have closed it out in that period around there. Now since then, the price then eventually broke higher. You would have started taking some long orders there, and you would have closed it out the very latest when the price on the daily broke in that moving average range, which coincided also when the price started breaking below the moving averages. And it's always good to sometimes zoom out just to get a 50,000 foot view. You can see there when both the CCI and the price were curving down and the price was below, that's where you would have closed out long positions. And you probably would have started getting ready to take short positions. And you would have taken advantage of those short trades. And that's where I've got now the short positioning. So from that point there, you can see there the stop loss approach jumped quite strongly, and so did the average down approach. And that would have generated some nice income, and you would have closed out those trades on the hourly when it broke into that moving average range, giving you a pretty low point to close out, and with very minimal upswing. Now at the moment the price did drop a bit further, and eventually currently it's consolidating, giving you a slight bullish momentum with the CCI and the price above the moving averages. But don't go long until you see the daily also start going long, which is a fair way off. Also notice on the daily, I didn't mention, you've got this massive fair value gap, so we might see the price in the near term break higher and fill those orders in the near term. So just be cautious about going short too strongly. So here for iron ore, the price on the monthly is below the moving average, giving us a bearish momentum. There's no CCI for the monthly. On the weekly, the overall trend was declining, but notice both the price and the CCI broken higher. Now this could just be a false break and continue on a downtrend. We'll wait and see, but at the moment bullish momentum on the weekly, and you would have taken long trades based on that on the daily, and that's where I've got this arrow highlighting. You would have taken long trades from that period when the price on the broke above the moving averages, and so was the CCI above the moving average. And if you're trading that on the daily, at the very latest you would have got out when that CCI broke into that moving average range on that candle there near the top. So that would have been a nice little trade to take on the daily. Now looking at the 1 hour period, again going long from that period, this is a long back test for the stop loss approach and the average down approach. And again, at the very latest you would have closed it out with that moving average breaking in on the CCI on the daily. But also take note of any bearish divergence. So each of these periods back here, you'll notice the CCI declining and the price keep rising. Now in this case, you would have let the price rise, and you'll know that as long as those moving averages keep rising, which they were, let it go. Even though the price, you've got to watch it very carefully though. And what you're waiting for is the price to decline and start with the moving average band curving down like it did there. That was a beautiful exit, letting it run through that whole period, even though the CCI was declining. That's how you would have gained that little trade. And this one, had you let it run through the whole period, you would have closed out at about this area there. Stop loss approach generated about $30, and the average down about $104 on those contracts. So here we've got spot gold on the monthly, very strong bull run above the moving averages and still rising. No CCI for a drawn on the monthly, but do note these fair value gaps down here, very long term, and the price may very well coming down to those ranges. But again, that could be a very long term play, if not months or even years. So just be cautious. Don't go placing short orders based on that. On the weekly, we do have a bearish divergence, lower highs on the CCI versus higher highs on the price. Don't start going short yet, because you want to wait for the moving average band to start turning down like it did back here. So at the moment, it's still bullish on the price, but although it's showing bearish movement on the CCI. So cautiously bullish at the moment. On the daily, again, consolidation period at the moment. The CCI is slowly declining with the price somewhat moving sideways. So just undecided at the moment. I'd like to see a break above this resistance to be more bullish at the moment, or I'd like to see a stronger break to the downside to be bearish. And the CCI is showing a potential downside. So just be cautious of that. As well, we've got these fair value gaps down there. This one up here has already been penetrated with those candle action there, that those orders have been filled. So if we go to the the 1 hour time frame. Again, looking at the 1 hour, at the moment you'd be going long with that candle breaking above, but you would have gone short during that little period there based on the daily, and that was equivalent to this area here on the 1 hour time period. And again, you always pay attention to any divergence, and up until that point you would have taken short entries, close it out when the CCI break into the moving average range, go short when they're both below the moving averages again. At that point, close it out when it enters the CCI enters the moving average range. You'll notice the CCI, when it enters the moving average, gives you an earlier exit as opposed to waiting for the price to break into the moving average range. So that just generally gives you earlier exits and maximizing your returns generally. Now during this period, the price did rise, and you would have waited for the price to break below, then going short again closing it out near the bottom there. At the moment it's going long, and notice it's creating this fair value gap. So we might see the price break strongly to the downside in the near term, in the next few hours, to fill those orders. Looking at the back test for going short, now I've drawn this arrow here, you would have started going short predominantly during this period when the price was below, and stopped taking short entries when the price was above the moving averages. And at each of these places as well, you would have noticed there was also some bullish divergence, and that's where you would have closed out your short positions once you start seeing the price break above the moving average band at that point, as well as the CCI, and paying attention to that bullish divergence. So at the moment, had you let it run through the whole period, the stop loss approach generated about 855, whereas the average down generated about 5,600. But I'm not saying you let it run through the whole period. Always pay attention to the higher time frame movements to trade on the lower time frame. So platinum's been giving us a massive rise in the last few months, although notice it's starting to pull back here on the monthly. There's no CCI for it. Still very strongly bullish, but notice this fair value gap identified, and this month so far it's just broken into that fair value gap, and we could see further declines. On the weekly, likewise, still above the moving average on the price, and notice the CCI has broken into that moving average range, giving us a weakening signal, and very likely will come down, and they've got these fair value gaps down here, and very likely we'll see the price pull back towards those moving averages to fill those orders. On the daily, likewise, we've got a bearish divergence versus higher highs in the price pull back. We drew a target here in our last video, and it's actually broken down and filled that divergence range. Sometimes it just touches that and bounces, other times it goes right through it. It looks like it's possibly going to break right through it with the CCI still dropping. Also notice on the daily chart, in the near term, we've got these fair value gaps up here, so you might see a price break further to the upside in the near term. But also longer term, we've got this massive fair value gap down here for all these unfilled orders. So you might see the price drop further before possibly retracing to the upside. But at the moment, if you're trading on the hourly, predominantly short trades. And what I've got here on the 1 hour chart, going back to this point, just demonstrate the trading strategy, going long around about the 16th of April. Stop loss approach and the average down, and you would have started going long. Again, paying attention to any bearish divergence. You can see there higher prices versus lower highs on the CCI. And when the moving averages start bending down, you would have started closing out your trades at that point there. Go long again when both the CCI and the price are moving higher above the moving averages. Watch for any bearish divergence, which happened there again. Wait for the moving averages to start bending down and close out your positions there. Go long again, and so on. Now, and alternatively, as a last resort, make sure you're watching the daily. You can see that also coincides with this period here on the 1 hour time frame. Doesn't always do that, but even if you're not following the hourly here and paying attention to divergence, always pay attention to the daily and see what it's doing. So at the very latest, you would have got out of the trade on that little candle there. But at the moment, avoid going long. As I said, the price and the CCI on the daily are bearish, so taking short trades only. So for spot silver, on the monthly, still very bullish. Although notice we've got this fair value gap. I'll mark it just to highlight it. That range there, we very likely see a price retrace to the downside and fill those orders in that range there. But also notice this fair value gap here, very long term. Again, that could take years to play out, so I don't go placing short orders. We take orders, take trades direct in the direction of the price and the CCI moving averages. So at the moment, taking predominantly long orders if you're trading on the weekly in direction of the monthly. On the weekly, still bullish on the price, but notice it's broken into that moving average range, so giving us a neutral positioning. So if you're trading on the daily, avoid going long or short until we see a decisive move on the CCI for this one. On the daily, we've got a Also notice on the weekly we've got these fair value gaps again. That's also coinciding with the monthly, so we might see the price retrace to the downside on that one. On the daily, we had a bearish divergence, lower highs versus higher highs on the price. Price breakdown, it's hit our target range. We drew that target before our last video, and it's broken right through that target range of a divergence. Also noticed fair value gaps down here, so we might see the price drop a lot further. But also short term, we might see the price break higher to fill these unfilled orders in that range there to the upside. But again, predominantly taking short orders based on the daily if you're trading on the 1 hour time frame. Going to the 1 hour time frame at the moment, I've taken back the back test to this point when the price and the CCI are above the moving averages and let it run. Notice the profitability started dropping off when the price also dropped off on the 1 hour time period. But again, taking note of price moving above and below the moving averages, especially on the CCI, but also take note of any bearish divergence if you're going long. So US crude, still bearish on the price chart on the monthly. You can see on the CCI, it's in that moving average range, give us a neutral signal. So just be cautious. We might see further upside. So if you're trading on the weekly, wait for that to break to the downside on the monthly. On the weekly, it's about to break higher above that moving average range, so just wait for that to break higher. We might see it break, keep going high, and that's why we always look at the lower time frames. But at the moment, cautiously going long, but wait for that to break above the moving average band. Also notice these fair value gaps I've highlighted. These are all being filled with the action of those candles, and this one down here remains unfilled, so you might see a break to the downside possibly. On the daily, more recently, we've got this fair value gap here, and about half of that's been filled already with these candles, but we might see further upside. If I zoom in, we had a couple of fair value gaps here. This one's been filled already with that candle, and this one here remains to be filled. So you might see a break to the downside to fill that one shortly, unfilled orders, and if that breaks below the moving average band, and the CCI does as well, then we're going to start taking short orders on the 1 hour time frame. So go to the 1 hour period. Again, I've got the back test here to go long from that arrow when both the CCI and the price are above the moving averages. You would have gone long during that period, but taking note of any bearish divergence and closing out your trades when they broke below the moving average range at that point there. At the very latest, if you're going long during this period, even if you let it run, just be cautious about waiting for it to break into that moving average range. You'll notice the CCI touching that moving average range there was at that top of that candle there. So that gave you an early exit rather than waiting for it to break on the moving average of the price on the daily. But again, always follow the hourly as well if you're trading on the hourly to make sure there's no divergence against you. In this case, if you're going long, watch for any bearish divergence. And lastly, back here, you notice here we had a drawdown, and you would have gone long during this period and avoided going long as soon as you start seeing the price and the CCI break to the downside. A couple of little divergence in there. Remember to reference the +1 videos where we look at various strategies, and they're in the links to the description below. Thanks for watching, and we'll see you in our next video.